A very good morning to you, all of you students. My name is Divas Gupta, and we will be discussing on the topic of advanced capital budgeting today. Yeah. So, students, in your intermediate CA, you would have already studied about the basics of capital budgeting. In this topic, we are going to take that to an advanced level. So, we will start our discussion with some of the current trends in the capital budgeting just to understand what are the implications of those in the capital budgeting. Good morning, Tariq. Good morning, Devansh. So, students, let's start our discussion. So, the first trend in our capital budgeting is on inflation. So, what is exactly meant by an inflation? We have to understand that as a concept, and we have to understand how it impacts the capital budgeting decisions. Students, all of us know that practically none of the economies, whether it is India, whether it is any developed nation, is absolved of inflation. So, what is inflation? Inflation is the general increase in the prices of the basket of goods. How those basket of goods, which are, let's say, valued at 100 rupees today, will be valued 1 year from now, is basically the inflation. So, when we talk about inflation, we always hear about two terms, which some of you might be already aware of, but I thought I'll just put it for the clarity. One is nominal, and second is real. Now, what is nominal and what is real? Whenever students, you read something called as nominal interest rates, nominal cash flows. So nominal can be anything, right? Interest rates or cash flow, correct? We can say there is a nominal interest rate, or we can say there is a nominal cash flow. Similarly, real, we say that there is a real interest rate or real cash flows, correct? Now the question comes, what exactly is meant by real and nominal? Good morning, Shailesh. Good morning, Mansha. Okay. So now when we are talking about inflation, these two terms are very important to understand. Good morning, Viraj. Good morning, everyone. So can anyone of you tell me what is the basic distinction between nominal and real? What is the basic distinction between nominal and real? Whether it is an interest rate or whether it is a cash flow. So can anyone would like to attempt this? What would be the cause of difference, or what is the general difference between these two terms while we talk about inflation? Because in our practical life also, we would have heard somebody saying nominal interest rates, nominal cash flows, similarly real interest rate, real cash flows. But what is the difference that drives these two different definitions? Students? Okay, good. Uday Pratap has attempted it, and Uday is saying maybe it is interest. Okay. Thanks, Uday, for that answer. If anyone else would like to attempt, think and write whatever. There is nothing wrong or right in my session, at least. We just want to make it more interactive, students. So whatever you think, whatever are your thoughts. Okay. Jyoti is saying nominal is minimum expected and real is actual. Okay. Nice attempt. Devansh is saying real is based on after all adjustments. Okay. Kirti, good morning. Okay, students, now we have, fair representation of the thoughts. And let me bring in what is exactly nominal and what is real. I will put in a very layman language. Nominal is something that includes inflation, and real is something that excludes inflation. Okay, we have more answers. Mansha is saying, perfect. Nominal interest rate includes inflation component, whereas real rate doesn't include. Very good, Mansha. SK Tariq Ahmed is saying nominal is the inflation adjusted, but not risk adjusted, but real is inflation. Okay, nice. So, students, if you see nominal, when we talk about nominal, it always includes inflation. When we talk about real, it excludes inflation. Now, just to give you an example, just to give you an example, so any interest rate. Okay, let me ask one more question that will help clear all the doubts. So now Uday is asking, is it interest that causes inflation? I am coming to that only, Uday. So students, just for a moment, keep aside nominal, real, inflation, everything. Just tell me why there is a need to pay or receive interest. If I borrow or lend money from someone, I have to pay or receive interest respectively. My question to all of you is that primarily, why do we need to pay interest? Or you can tell me what are the components of interest? Because of what all reasons we charge interest? Students, come on, attempt this question as well. Can you give me those reasons why interest is charged or recovered, whatever is the case may be? Yes, students, please attempt this one as well. Okay. Tariq is saying sacrifice made today. Okay, perfect. So Tariq might be saying because of the opportunity cost, which is perfectly right. Shailesh is saying time value of money. Very good, Shailesh. Suraj Kulkarni is saying because of time value of money and opportunity cost of lender. Very nice, Suraj. Mansha is saying to compensate the risk. Very nice. So I think again we got almost all the parts covered here from all of you. Thanks for answering. So accordingly, so Shruti is also saying time value of money. Very nice, Shruti. One is actually time value of money, and second is risk. If I'm lending money to someone, I am undertaking a risk of non-payment of the principal. Okay. For that also, I will ask for some of the consideration so that I am covered for my risk and time value of money, of course. Perfect. Kirti is saying lender wants something in return of money. Very nice. Uday is saying because that difference. Yes, perfect. So, students, now in the interest part, generally we denote time value of money by inflation. So, can we say that some part of interest is actually inflation driven? Correct? Some part of interest is actually inflation driven. So, whatever is the balance part left, that is your real interest rate. Okay, students. Now let's understand how do we toggle between real and nominal, and then we will move to one of the example to actually form up the discussion. So I think till here, are all of you with me? Okay, let me not write this. Just a second. So students, now what is the relationship between real and interest that we are talking about? Sorry, real and nominal that we are talking about, right? Now there are two ways to equate real and nominal. Okay, one is, and of course, inflation, because the difference between real and nominal is only inflation. So we can write that inflation is equal to nominal rate of interest minus real rate of interest. So this will give you the inflation. So one school of thought is that you just reduce real from your nominal, you get the inflation because this includes inflation. This includes inflation as per the previous concept that we discussed just now. And real, this excludes inflation. So if you reduce both of them, you will get inflation. Mansha, we will come to that. Okay. But in this, there is a inherent risk. What is the risk? We are just taking the absolute interest rate and reducing it. The second way we calculate inflation is inflation is equal to 1 plus nominal rate divided by 1 plus real rate minus 1. I can actually simplify this and rewrite as below, which is easy to understand. Okay. 1 plus real rate multiplied by 1 plus inflation is equal to 1 plus nominal rate. The above equation itself, I have rewritten and rearranged in an understandable manner. So students, please have a look here. This is the real rate. By real rate, I mean real interest rate. Okay. This is also nominal interest rate. Okay. Okay, students. So the real rate, if you multiply inflation, then you get nominal, because nominal is something that includes inflation on top of real. So real multiplied by inflation, but you can't just simply multiply them because there has to be a there has to be a plus sign in between. Why? Because if you don't do, you will arrive at the compounded number which is wrong. So imagine you have 100 rupees today. On that 100 rupees, you will multiply real rate, and then on that you will take the inflation. This will be very clear from one of the example also, but I'm just trying to make it clear that this is another way to represent the nominal rate and real rate. Okay, students. Now, if you see, students, this is equation number 1, or let's say the first method, and this is the second method. Now, please focus that if you have anything, let's say you have nominal and you have real, you have to calculate inflation. You can do that. Let's say you have nominal and you have inflation. You have to calculate real. Can you do that? Yes. So out of these three, if you have two, balance you can arrive at. Okay, students? I hope this is clear. Now, let's take an example. Let's say I'm telling you that nominal interest rate is equal to 10%. Real interest rate is equal to 8%. Okay. Can you help me find out what is inflation? Can you help me find out what is inflation? So very easy, very simple. If we apply the first method, we just take a difference. So the inflation will be very good, Kirti, 2%. Basis our first method, it will be 2%. Basis our second method, it will be inflation will be 1 plus 10%, which is the nominal rate, divided by 1 plus 8%, which is the real rate, minus 1. In this case, the inflation, if we solve the above equation, will be what? Very good, Gurram, Venkat. This 2% is absolutely correct. So if we solve this, it comes as 1 plus 10%, 1.1 divided by 1.08 minus 1. So in percentage terms, it comes as 1.8518 percentage. Very good, Shruti. Yes. Now, students, always you prefer this formula. Okay? Because if you see, students, in real life also, what happens? We are standing here and we are talking about 1 year from now. Very good, Uday. Very good, Kirti. Yes, your answers are correct. Shruti, you are right. Perfect. So, we are saying that the regular interest rates from here till here are 10%. Okay. But the inflation has eaten up. The inflation has eaten up 8% from this 10%, and hence it is taking the overall number down. So, in a way, out of this 10%, 8% is being, 2% is being eaten up in the inflation. Now, exactly it is 2% or what? That we have to compute, that we are trying to answer it, right? So the way you go in the future value, similarly, you have to come to the present value. Hence, if you see this formula, this is exactly doing that. It is first of all taking you to the future value, which is 1 plus 10%, and it is bringing back to a present value to arrive at the inflation as on today. Good morning, Ravi. Okay, students. So hence I'm saying always prefer this formula. Now, if you think it from a cash flow perspective, till now we have discussed interest rates, right? Real rate, nominal rate. If you talk about real cash flow, nominal cash flow, the concept remains same. Real cash flow is something that excludes inflation, and nominal is something that includes inflation. Yes, Kirti, second method considers value. You're right. First method only will give you the percentage. But I would still say that preferably use second method only until and unless specified in the question. Okay. And this discussion is really important for your understanding, not only on the advanced capital budgeting, but also whenever it comes to real and nominal. Because this thumb rule remains same. Whatever is real, that excludes inflation. Whatever is nominal, that includes inflation. Okay? Perfect. Now, let us go to question number 1 from our assignment. Mansha is saying purchase power parity. Yes. So, yes, students. Question number 1, determine NPV of the project with the following information. So, students, we have our basic knowledge understanding from our intermediate sessions where we discussed about the regular capital budgeting, right? So we are not touching upon that. We are just simply now evaluating the impact of inflation in those decisions. Okay. Yeah, let's start, students. Perfect. Determine NPV of the project. What is NPV? Net present value. How you calculate net present value? For calculating net present value, you take present value of cash inflows minus present value of cash outflows, correct? Present value cash inflows minus present value of cash outflows. Correct, students? This is how we used to do. The initial outlay of the project is rupees 40,000. Annual revenues without inflation. Now, can you tell me whether it is a real or it is a nominal? This is a real because it is not having any inflation. Annual cost excluding depreciation without inflation. Again, this is a real 10,000 rupees they are incurring as an expense. They are earning 30,000, they are incurring 10,000. That means 20,000 they are making margins. Useful life is 4 years. 4 years is the useful life of this project. Salvage value nil. At the end of the project, we will get zero value. Tax rate, the tax at which you have to pay on the earnings is around 50%. Cost of capital, including inflation premium of 10% is 12%. Students, just open up your mind. Tell me for real cash flows, right? The cash flows are real, right? But what is the interest rate that is given to you? Is it real or it is nominal? Yes, students, please attempt to answer this. I'm asking whether this cost of capital is real or nominal. Please answer my question first. Yes, students. So Suraj is asking, present value of outlay is usually the same. Yes, Suraj, because outflow we have done as on today and it remains same. There is no change there. Very good, very good, very good. Everyone is saying perfect answer. Tariq, Shruti, Shailesh, Mansha, Kirti, Guram Venkat, Ravi, Devansh. Everyone is saying nominal except for Suraj. Suraj, please check once. I'm asking about this interest rate. The question mentions interest rate includes inflation premium of 10%. If it is including, it is nominal. Now, student, just apply your mind. Cash flow, real. Interest rate, nominal. Don't you think either cash flow needs to convert it to nominal or interest rate convert needs to be converted to real? Then only we have to do the calculation. Yes. Anumula Sai, yes, you're right. Nominal. Mansha, yes, we have to adjust the cash flows. Either we can adjust the cash flows or we can adjust the interest rate so that both of them are either real or both of them are either nominal. I hope The problem statement is clear. I was just trying to define the problem statement till now. Okay. Now let us attempt the question in both the approaches. In first approach, we will change the cash flows to make it as nominal. In the second approach, we will change the interest rate to make it real. Okay. So approach one, real cash flows to be converted to. So, okay, let me put it like this. To be converted to nominal cash flows. So, students, let us calculate the real cash flow first. So, in our question, it was given annual revenues is 30,000, annual cost is 10,000. So, 30,000 minus 10,000 multiplied by 1 minus tax rate. Okay. Plus, you will also get tax savings on depreciation. What is the depreciation? Depreciation will be 40,000 by 4, right? Depreciation will be 40,000 divided by 4, which is 10,000 per annum. Okay. So on this 10,000, you will get a benefit of 50%. So this 20,000 into 50% is 10,000 plus depreciation you will get as 5,000, the benefit. Hence 15,000 becomes your real cash flow. Now, nominal cash flow will be real cash flow 1 plus inflation. Okay, students? So we can simply put year 1, 2, 3, and 4. Real cash flow is how much here? 15,000, 15,000, 15,000, and 15,000 for all the 4 years. Nominal cash flows. For first year, it will be 1 plus 10%. For second year, since this 10% is per annum, so for second year, it will be taken 2 times. Third year, it will be 3 times. Fourth year, it's just like compounding. First year compounding happens once, second year twice, third year thrice, fourth year 4 times. Okay, students. Yes, Devansh, because of matching concept. Because we have to match the cash flows with their nominal and real. Hence, we are doing this. So, this comes as 16,500. This comes as 18,150. Then this comes as 19,965. And then 21,962. Now, can we calculate our NPV? Yes. So 16,500 has to be divided by. Now, these have become the nominal cash flows. We can use the nominal rate. Nominal rate is 12% plus 18,150, 1.12 raised to the power 2 plus 19,965, 1 1.12 raised to the power 3 plus 21,962 1.12 raised to the power 4 minus initial outlay was how much? 40,000. So NPV becomes 17,369. Okay, students. Then approach 2, we are saying that we will convert the nominal interest to real interest. So the real rate will be 1 plus nominal rate divided by 1 plus inflation minus 1. So the real rate will be 1 plus 12%, 1 plus 10% minus 1. So this becomes 1.8%. Now students, the discounting will happen basis 1.8% because the cash flows are also real. So the NPV in this case will be 15,000 divided by 1 plus 1.8 percentage plus 15,000 divided by 1 plus 1.8% raised to the power 2, 15,000 divided by 1 plus 1.8% raised to the power 3 plus 15,000 divided by 1 plus 1.8% raised to the power 4 minus 40,000. So here also NPV is approximately across 17,367. So Suraj is saying we will have present values factor table also, sir. We can take values from there. Yes, multiply by n. Yes, Suraj, that is very much. If it is available, then instead of doing a monthly or an annual basis, you can directly take it from there as well. Shruti is saying 1.1818. Shruti, just check once. It should be 1.8%, not 1.18. Okay. So if you see here it is 1.12 divided by 1.1 minus 1 into 100. So Shruti, you are not doing this minus 1 it seems. Just check once. Okay, just check once Shruti. Because we are trying to calculate the rate, and why this minus 1 here is because it was here 1 plus real rate, right? So if you only take the real rate, minus 1 has to go to the RHS side. Then next is Gurram is saying, sir, in second case, inflation rate 2%, but you have taken 10%. Gurram, please check okay, let me also check the facts of the question. It says inflation is 10%, Gurram. So if you see inflation is 10%, nominal rate is 12%, then what will be the real rate? real rate will be 1 plus 12% divided by 1 plus 10% minus 1, which is 1.8%. Okay, students? Okay, Shruti. Perfect. So your answer is also correct, Shruti. 1.818. Perfect. I hope students till now we are clear in our understanding about the real interest rates, real cash flows, nominal interest rate, nominal cash flows, and some of its applications till now. We will also do this question number 2, which is again part of the assignment. Okay. Manisha is saying, sir, here cash flow occurs at present T0 if in case cash flow occurs during the projected period. We have to adjust this also. Very good question, Manisha. Now, definitely we will have to adjust until and unless question specifies otherwise. Because the underlying principle of real and nominal is that whatever is today cannot be compared with the tomorrow's cash flow. It has to be adjusted. So we will adjust that, Mansha. Okay. Until unless question specifies. So Kirti is saying any method we can apply in exam. Yes, Kirti, it is up to you. If question asks you to adjust cash flows, you adjust cash flows. If question asks you to adjust the discount rate, you adjust it. Otherwise, you have a choice. Okay. Let's come to question number 2, students. I hope all of you are enjoying the session and along with the proper understanding and whatever are your questions, please do keep on posting the query handle. Okay, students? Perfect. Let's come to question number 2. XYZ requires rupees 8 lakh for a unit. Okay. Useful life of the project is 4 years. Salvage value nil. Depreciation charge 2 lakh per annum. That we can also compute because depreciation 8 lakhs divided by 4. That is 2 lakh. Correct, students? Expected revenues and cost excluding depreciation, ignoring inflation. Now, this also they have mentioned ignoring inflation. Revenue and costs. These are given. Are these real or nominal? Students, come on, please answer. Are these cash flows real or nominal? The tax rate is 60%, cost of capital 10% is including inflation premium. It includes inflation premium. So my next question will be, is this real or nominal? Is this real or nominal? Perfect, Kirti. Kirti is saying real. Cash flows are real. Shailesh, real. Shruti, real. Gurram, real. Devansh, real. Very good. I think Kirti is now telling about this. The cost of capital. It is nominal. Perfect, Shruti. Perfect, Kirti. Yes. So I think all of us are correct. Now, the question is asking us to calculate the NPV of the project if the inflation rates for revenue and cost are as follows. Revenue is this much, cost is this much. Now, student. Okay, Manisha is saying capital budgeting on Sunday morning. Fog is equal to good combination. Okay. Good, Manisha. Tariq, real. Yes. Anumala Sai is saying real ignoring inflation. Perfect. If it is ignoring inflation, it is real. Shruti, cost of capital is nominal. Yes, Shruti, perfect. Devansh, nominal interest rate. Very good. Guram, tax rate is nominal. Okay. Tax rate is not nominal. Cost of capital is nominal. Okay. Now, students, I think good round of, answers from all of you because I think every one of you is correct and understanding on the right path. Very good, students. So, students, now through Actually, this question is something different from the previous question. Can anyone tell me what is the underlying difference? Or have you noticed some something wrong in the question number one that we did, which we did intentionally, but I just wanted to hear from all of you, according to you, is there some assumption that we have taken wrong? Because I think Mansha tried to touch upon that. Mansha said that the cash flow has occurred at T0, and hence we are not applying it for any inflation. Okay, I agreed to that. But there was another consequence of that. What was that consequence that we did? Kirti is saying inflation rates are given. That is visible. So inflation rate here, it was given a single 10%. In the next question, students, it is given at a individual year-wise basis. But there is a very fundamental difference, students, I can tell you. And it is related to the initial outflow. That also I can tell you. Just think, in question number one, have we did something wrong which is not logical? And I'm telling in approach number one also. It is actually related to approach number one. In approach number one, something wrong we have did with the initial outlay of the funds. There is some consequential adjustments because of that. Can anyone think of that? I'm just trying to give you all of you a proper hint. Come on, students. We are all here to express our views. All of you are very much open to express your views in this session. Okay. So Anumala Sai is saying in this question, cost increased over revenues. No, that's not the concern. Inflation can be higher, lower. Inflation. So inflation rate that was 10%. Here it is revenue, it is different. Cost, it is different. Higher, lower. That is okay. Difference between inflation rate between cost and revenue. No, Devansh. I am asking in question number one, approach number one, we have assumed something wrong. Shruti is saying annual revenue cost should be inflated against adjusted, sir. No. Shruti, both the things we have inflated along with, okay, now let me come to the point. So students, hear me carefully. Approach one, we adjusted cash flows. What were the different components of cash flows? 1, 2, and 3. The first one was revenue. The second one was cost. And the third one was depreciation and its resultant tax. Correct? Students, in real life, revenue and cost increases with inflation. But will depreciation will increase with inflation? How is depreciation calculated basis the historical cost? Depreciation is never going to increase. But what we did, 10,000 depreciation multiplied by 0.5 on this 5,000, and this was 10,000 here plus 5,000 from depreciation. Total we took 15,000 and we kept on applying inflation on this number, which includes 5,000 of something which is never going to increase in life. Please open your brains. I hope you're able to get my point. So on this depreciation, we have also applied inflation. I did it knowingly because I want to bring out the difference. In practical life, we never assume any inflation on depreciation. because depreciation is based on historical amount. And that is where I was trying to say, Mansha has also asked, right? Since the outflow has happened at T0, there is no inflation we have applied to the outflow. Then why we should apply inflation on the depreciation, which is an outcome of that initial outflow? Okay, students. But we have taken 5,000 and implied inflation, okay, just to solve that answer. Even if you want to exclude 5,000 and apply inflation on only 10,000, that also will be correct. That will be a better preferred answer. Okay, students. Okay, Devansh. Okay, everyone. I think I am clear here. Now, the reason for picking up this question is because this question has not given you a generic inflation. It has given you different inflation for revenue and cost, but it has not given anything for depreciation, which is not needed also. Correct? Which is not needed also because depreciation will not increase. Okay, students, please help me understand whether all of you are with me till now. Okay, these small insights really help to build on the different thought processes. And that is what is needed. Okay. Okay, students, please ping if you have any questions till now, or are you there till with me? Perfect. Let's start this question. Now, in this, we are not given any inflation premium to adjust in the rate. We are given inflation premiums to adjust in the cash flows. So we will make real cash flows to nominal cash flows. Okay, students. Now, how can we make it? Very easy and very simple. Year 1, 2, 3, and 4. Revenue 6 lakhs, 7 lakhs, 8 lakhs, 8 lakhs. Then here revenue, inflation, edge. So, or we can say inflation included. Because sometimes some people feel if we write adjusted means increasing also, decreasing also, right? But we are clear, if it is including, then it is nominal. If it is excluding, it is real. Inflation included. Okay. So 6 lakhs. What is the first year inflation? 10% into 1.10. 7 lakhs into 1.10 will be for the first year and 1.09 will be the second year. 8 lakhs into 1.8%. Sorry, we'll start from the first year and then we'll go to the third year. So 8 lakhs, 1.10, 1.09, 1.08. So we can keep on writing the answers also here. 6 lakh 60,000, 8 lakh 39,300, 10 lakh 35,936. Then last one will be 8 lakhs, 1.10, 1.09, 1.08. This will be 11 lakh 8,452. Now similarly, cost table, year 1, 2, 3, and 4. So the costs are 3 lakh, 4 lakh, 4 lakh, and 4 lakh. These are the real cash flows. 3 lakh. Sorry, second one is 4 lakhs. Okay. Shruti is saying yes, sir, clear. Mansha is saying yes, sir, clear. Perfect. Devansh is also saying understood. Perfect. Perfect, guys. So 3 lakh, 4 lakh, 4 lakh, 4 lakh. The nominal cost will be 3 lakh. For cost, what is the inflation increase? 12, 10, 9, 8. 1.12. 4 lakhs. 1.12. 1.10. Then again 4 lakhs. 1.12. 1.10. 1.09. Again 4 lakhs. 1.12. 1.10. 1.09 and 1.08. So this comes as 3,36,000. This comes as 4,92,800. Then 537, 172, 580, 124. Perfect. Then we also have to calculate the tax benefit on depreciation, which will be given by 8 lakhs divided by 4, which is 2 lakhs. This should be multiplied with tax rate 0.60, 0.60. So which comes as 1,20,000. So 1,20,000 will remain same. There is no inflation here. It will keep on remaining same. So calculation of annual nominal cash flows. Now year 1, 2, 3, and 4. This is year. Revenues. These were how much? 6,60,000. 839,300. 1035, 936, 1108, 452. Costs 336, 492, 800, 537, 172, 580, 124. Net profit which is revenue minus cost will be 3,24,000, 3,46,500, 4,98,764, 5,28,328. Tax at the rate of 60%. So this net profit will be multiplied with 60% to arrive at the tax. So this becomes 1,94,400, 2,07,900, 2,99,258, 316,997. Then net profit after tax. So net profit minus tax will be net profit after tax. 129,600, 138,600, 199,506, 211,331. Shruti, small round off is okay. I think Shruti is saying it is 537, 152, 537, 172 should be okay. So students, all these questions are very much calculation intensive questions. Okay. So please do try to cross check it again. Then comes present value of cash inflows. Ultimately, we have to now come at the present value calculation of present value of cash inflows. Year 1, 2, 3, and 4. Net PAT, we just calculated 129, 600, 138, 600, 199, 506, 211, 331. Tax benefit on depreciation is how much? 1,20,000 flat. Cash inflow, then present value factor at the rate of 10%, then present value. These three columns we have to put. So the cash inflows are 249. So these needs to be added. Net PAT plus tax benefit of depreciation needs to be added to arrive at the cash inflow. 249,600, 258,600, 319,506, 331,331. So this will be 0.909, 0.826, 0.751, 0.683. So the present value will be 226,886, 213,604, 239, 949, 226, 299. So it becomes 906, 738. So finally the NPV will be 906, 738 minus 8 lakhs. This will be 1,06,738. I hope this is clear, students. Yes, students. So let's carry on. We'll continue with our next discussion points. So Mancha is saying, yes, good question again from Mancha. Sir, if we convert cost of capital into the real interest rate, in this case, we'll have to adjust interest rate for each year. Yes, Mancha, we have to do. But since the question is drafted in such a manner that you have different interest rates, you have different inflation rates for revenue and cost, in a way, you cannot do that basis this information at least. Okay. Hence, we have not adopted that approach. But in case there is a different inflation rate for that different year, then definitely it has to be adjusted in that manner. Okay. Now, students, okay, before we come to question number 3, let's discuss certain more discussion points. Okay. So, students, we started. Okay, let me first quickly recap. We started with advanced capital budgeting. I said that regular capital budgeting you would have studied in your intermediate. In advanced, it will have certain nuances from the practical life. The first one being inflation, where we discussed about inflation, real rate, and nominal rate. And I think all of you are clear now. What does real mean? What does nominal mean? And what is the interest? What is the inflation means? Plus, we discussed there are two ways to toggle or there are two ways to equate real and nominal. One is simple addition or subtraction. Second is taking them into the multiplication and division. Correct. These are two equations. Now, then we discussed that for assessing any NPV of a project, the cash flows and interest rate, either both of them should be real or both of them should be nominal. Then only it is apple versus apple comparison. Now, students, we will also discuss some of the other implications on the capital budgeting apart from inflation. The second factor which is given to you. So the first factor we discussed about inflation, let me mark it. Yeah. Yeah, this one. So I'm writing this as maybe with a different marking. So this is point 1. And after that point 1, now this is point number 2. Okay. So that you can easily know what is the sequence. In the second topic, we have to discuss about changes in technology. So students, what happens? Practically, we take a project for at least 5 to 10 years. Once you take a project of 5 to 10 years and start invest today, you do a investment today and you expect that project to be 5 to 10 years, then during the course of that 5 to 10 years, the technology in which you have invested today might become obsolete. Correct? And this happens practically. So I'll give you one example. So for example, there is a manufacturer who is engaged in producing packaged drinking water. Okay. Let's say he's selling a branded packaged drinking water. He's manufacturing that and selling it. Now, in this process, the way capital amount has to be spent is there is a filling machine, correct? The water will come in that filling machine and the filling machine will fill the water in that water bottle. So there are two elements in this, or rather three. The manufacturer will need bottle, the manufacturer will need a cap, and the manufacturer will need a water. They will put it into the capex on machinery, right? So the capital amount they have invested in the machinery, they will put all these things and the output will be a bottled water. Okay, so till now in market, no machine is available. So, okay, let me put it like this. Till now in market, the only machine available is to just take these three things as input, put it into the machine, and output will be bottled water. Okay. And let's say that manufacturer has started this line by investing, let's say 100 crore rupees in this for a matter of 10 years. Now, what happens while this is continuing after the end of fifth year, the in market a new technology comes where this bottle, rather than coming as a bottle, there is a small preform. Okay. I'm just using a term. So let's say there is a small preform. It is first of all blown into the bottle, like the plastic bottle, and then it goes to the filling machine. Okay. So this is a technological advancement, correct? Earlier, only the bottle used to come. Now, what that technological advancement has come is, now apart from filling the water in the bottle, the machine can also take a small preform and blow it into the bottle, and then go next part will go to the filling machine. So it completes the process. Now, what are the benefits arising out of it? The benefits is, earlier, the raw material or the packing material for this manufacturer used to be the complete bottle. Let's say this, like the bigger in size. So it used to come in the heavy transportation. Now only the small preform will come. So it will drive cost savings. It will drive efficiency. Correct? It will also make sure that the damage reduction is less, because in the same filling machine, first the bottle is also being created. Correct. I'm just giving an example. Okay, don't get confused in this, but just to tell you that, is this a technological advancement? Yes. Because earlier the finished, like the bottle used to come, now only a small preform comes, it is blown into the bottle, then it is going to the filling. Okay. So will it impact the earlier 100 crore worth of investment that was taking a complete bottle? Yes, it will impact, because the new players in the market will start using the new technology, and they will much ahead in terms of the production, in terms of the cost, in terms of the other things. So hence we say that practically these things also impact. The changes in technology also impacts. Okay, students. Now the third part. After inflation and changes in technology is that changes in the government policies. So students, as we all know that government actually intervenes certain policy decisions when it comes to interest rate, when it comes to the budget, wherein the tax related changes comes, the spending amount of government comes. So broadly, we have divided government policies into two parts. One is the fiscal policy. Second one is the monetary policy. So students, all this is given in your study material. Okay, I'm going with the same sequence. So inflation was there. I have explained that. Second, technological changes was there. We have covered that. I request all of you to go through that, you know, theory before the next session and ask me in case you have any questions. Now I'm explaining you the government policies. Okay, the third part, the changes in government policies. So the changes in government policy, students, has been spread into two buckets. One is the fiscal policy and second one is the monetary policy. So these are the two policies where government keeps on changing certain levers. Now, okay, there is a question. This is a general question again. I keep on asking. Can you tell me, RBI makes changes to the bank rates, the repo rate, the reverse repo rate, right? So that comes under fiscal policy or monetary policy. Can anyone attempt to answer this? So RBI's review of interest rate. This is question number one. Question number two is the yearly budget, which is discussed, deliberated in Parliament by the government of India, is a part of fiscal policy or monetary policy. So RBI review and yearly budget. These are the two questions. Students, please answer. So please mention RBI where, or you can mention one as F or M. F for fiscal, M for monetary. Second is the yearly budget. You can mention F or M, fiscal or monetary, just for simplicity. Okay. So very nice. Let's have good answers. So Suraj is saying one is monetary and second is fiscal. Okay. Guram is saying fiscal. Okay. But Guram, if you can mention the answers in such a way, we can understand for which you are saying for what. Okay. The first one is the RBI review of interest rate, wherein RBI keeps on changing the repo rate, the reverse repo rate, and it has implications. And second is the yearly budget. Yes, Mansha, AI technology, government, social environment, ESGs, BRSR, legal economic, all are macro factors. Yes, these are all macro factors. But the question as of now in our hand is we talk about government policies, right? Now, where, basis your understanding, where will you classify the budget and the RBI? So Devansh is saying first is fiscal, the RBI review is fiscal, okay? The second is monetary, okay? Guram is saying second is fiscal. The budget is fiscal, okay? So I'm just waiting for another 30 seconds for all of you to answer, students. Again, I would again request all of you to please attempt. Please think and write. Mansha is saying RBI is monetary, budget is fiscal. Okay, very nice. Come on, students. Please attempt. Perfect, students. So I think we have enough answers and enough representation. Now, let me first explain the fiscal. We will come to the answer. Okay. What is the correct answer? We will come to that. So the fiscal policy is actually a policy which elaborates the government policies on tax, government spends. Okay. How much government is going to earn from tax? How much government is going to spend on the different amounts that they are incurring? Okay, Manisha is saying fiscal and monetary both go hand in hand. Kirti is saying first is monetary, second is fiscal. Very nice. Thank you. Thank you everyone for answering. Now hear me out. Fiscal is actually to do something which decides that what is the tax of the government, tax revenue of the government, and what is the spending of the government. Monetary is something which governs the use of the different monetary instruments. Let's say the cost of money, availability of money, availability or supply of currency, I can say, rather than money, I'm saying currency. Okay. So budget is part of the fiscal policy. RBI rate review is part of the monetary policy. Perfect, Kirti. First is monetary, second is fiscal. Okay. So the monetary policy is actually where RBI is changing the rates. Now, how it will impact? The impact is divided in two forms. If we take domestic capital budgeting, right? So how fiscal will impact and how monetary policy will impact. Let's come to this. Fiscal will impact. Yes, it will definitely impact. We take a tax rate assumption 10, 30%, 20%, 40%, 50%. If tomorrow in the budget the tax rate is changed, it will impact the practically it will impact the capital budgeting because initially we thought 30% will be the tax rate in the fifth year. Now in the fifth year, the budget comes and the tax rate decreases to 20%. Okay, students. So tax rate plus budget also announces the incentives. If for any backward area investment, there are some incentives to be announced. And considering that we invested some amount in those areas, now today the government withdraws those incentives or the sunset clause is increased or decreased, it will also change the amounts, right? So tax, incentives, subsidies, all those things will come under fiscal. Monetary, bank rate, rate of interest, cost of capital, those all things will be part of this. Now, for international capital budgeting, again, the impact is clubbed under two, fiscal and monetary. But in case of fiscal now, the impact can be classified as, let's say, double taxation avoidance agreement, DTA, because DTA are also introduced to avoid double taxation of the same income in one country and another country. Since this is international capital budgeting, the tax should happen at only once. So this can be one of the influencing factors. Similarly, for monetary, the bank notifies bank rates, right? In a way, it actually controls the demand and supply of currency through bank rate. And in a way, this also controls the exchange rate of currency. Okay. So this actually impacts the international capital budgeting exchange rate. I hope you got the linkage because if the exchange rate is high or low, the exchange rate, the capital budgeting from an international standpoint will also become a change. Okay, students. I hope this is understood, students. Okay. Any questions, students, till now? So fiscal and monetary. Fiscal, where government talks about its spending, its revenues through tax, its incentives. Monetary is something which is to do with the control of the supply or demand of monetary instruments into the market, which is currency. Whether they want to reduce it, whether they want to increase it, what they want to do is similarly specified there. Okay, students. Now let's move ahead. So the recent trends, the current trends in capital budgeting, that topic is over now. We're moving to the next topic. How to analyze risk in the capital budgeting. Okay, students. Now I'm writing three statements in front of you. Certain, risk, and uncertain. So I can mention here the second broad topic, risk analysis. Okay. Or let's say dealing with risks. I'll use the same notes, dealing with risk. We will come to each and every term here. What do you mean by risk? How to evaluate that risk? How to integrate that risk in our capital budgeting decision. Okay. So I have put three terms here, students. One is certain, second is risk, and third is uncertain. Now, what do you mean by certain? Certain is something that is bound to happen, which we know that there are 100% chances that it will only happen. So 100% bound to happen. What is risk? Risk is that we know that this might happen or this might not happen, but there are certain chances or probability attached to it. Since we're talking about capital budgeting, hence I'm saying I can explain it through a scenario making. So let's say cash flow probability. Let's say there are 4 possibilities. So the first possibility says that 2000 will be the cash flow, but there is a 20% chance to it. 3000 can be the cash flow, but there is a 30% chance to it. 5000 can be the cash flow, but there is a 40% chance to it. And 1000 can also be the cash flow, but there is a 10% chance to it. So this totals as 100%. Okay. The probability totals as 100%. Now, don't you think, students, this part is denoting some risk. What is this risk? Whether whatever we have specified here will be the actual outcome or not, because these are the different possibilities. You see, students, just focus on this term. These are the different possibilities. These are not the real outcomes. In certain situations, we are actually aware that this much is 100% bound to happen. There is no different possibility. We know that rent has to be paid 10,000 per month as per the agreement. This is a certain cash flow. For every month, 10,000 will be in cash outflow. But risk, we don't know how much sales we are going to clock. But we have possibility scenarios. In the first possibility, there is a 20% chance we will clock 2,000 rupees of sales. In the second possibility, there is a 30% chance we will clock 3,000 rupees of sales. You're getting my point. And something that is called as uncertain situation, where we can't even make out different scenarios. Not possible to make different scenarios also, because this kind of a situation has arrived for the very first time. Okay. Now, when will a certain situation happen? If there is a agreement in place. Okay. So let's say cash flows are backed up by an agreement. Even for sales, there is an agreement with Government of India to supply, let's say 10,000 units on a monthly basis. So this is a bound cash flow, right? This is a certain cash flow because there's an agreement of supply. When will be there an uncertainty? Uncertainty will primarily be there when we are dealing, let's say, with a new product. We have launched a new product. We don't know what is the demand and supply of that new product. We are new to that market. We cannot even come up with the different possibilities. Correct? That what is going to be an outcome. Okay, students. And one more situation of risk that I'm talking about is the different scenario making. Now, in this scenario, if I ask you, okay, you have articulated four different possibilities with the cash flows and the probabilities, but can you tell me what is the best possible outcome? So for that, what I will do, I will just multiply the probabilities with the different cash flows, right? So 2000 multiplied by 20%, which is 400. 3000 multiplied by 30%, which is 900. 5000 multiplied by 40%, which is 2000. 1000 multiplied by 10%, which is 100. So the total is 3400. So this is actually the best possible outcome, students. Correct? Agreed? With me till now, students? I hope this is clear. The three distinctions has to be kept in mind. There is something called as certain, there is something called as risk, there is something called as uncertain. Practically, this is the situation that prevails. I will not find any single capital budgeting decision which will not have risk element in that. Risk of forecasting, risk of defining the cash flows, how much it will be. Because you stand on day zero or year zero and determine the future cash flows. Basis that you take the decision. Here we are talking about that there is a risk. There can be an estimation error. Correct. So we will discuss how to tackle that in our subsequent part. Okay. So students, let us break for 10 minutes. 8:26 now. Let us reconvene at 8:36 and continue our discussion. So welcome back, students. Now, taking our discussion ahead from what we discussed just now. So there are two ways to analyze risk, or let's say two ways to understand the problem statement again. I'm just taking the risk part ahead. So just see, I will be writing, let's say, two different things, and then you will be able to make out what is the difference and which one is the better one. So the first one is average cash flow. If I just ask you, this is the information given in this scenario for four different possibilities and four different cash flows with their probabilities, what is the average cash flow that you expect? All of you will say 3400. Okay. All of you will say it is 3400. Why? Because 3400 is arrived at multiplying the different probabilities with the cash flows. Now, if I also tell you that apart from average cash flow of 3400, there is a risk of plus minus 500. What does this mean? This means that 3400 can go down to 2900, or it can go up to 3900 also. While I'm telling you that on an average basis, you will get 3400 as your cash flow, but there is a risk that your cash flow will be lesser by 500 or it will be higher by 500. You're getting my point, students? So Mancha is saying future is uncertain, complex, hence we can't eliminate entirety, but can minimize it. Yes, we have to minimize it. So that is the entire objective. We have to quantify what is the risk, and that quantification has to be used in this understanding. Now, don't you think you are well equipped? You are better equipped from situation one, in which it was only told you that 3400 is your cash flow. But in the situation two, apart from your average cash flow, you are also being told that there is a risk of plus minus 500. So you are in a better position to take decision in the second situation, because you understand that there is a risk element also in the cash flow. So now let's relate it to what we have to solve for. Average cash flow or best possible cash flow is represented by which statistical measure? Can anyone attempt this? And is risk is again risk is denoted by which statistical measure? So before we go to that, let us first try to define risk. Risk is what? Risk is deviation of possible outcomes from best possible outcome. This is a very plain language I'm writing just for all of your understanding. Okay. So we said that, okay, let me come back here. These are the different possible outcomes. 2000, 3000, 5000, 1000. These are the different possible outcomes. The best possible outcome is 3400. Correct? Now my question to all of you is, first tell me what is denoted for best possible outcome or average outcome? Which statistical measure we use? For example, mean, median, standard deviation, variance. And similarly for risk also, since we say that risk is a deviation of possible outcome from best possible outcome, which method we will denote. Yes, Tariq has attempted it. I think average cash flow is equal to mean. Risk is standard deviation. Very good, Tariq. Manisha is saying standard deviation. Very good. Kirti is saying value at risk. Okay, good to hear that. So students, average cash flow or best possible outcome is actually referred by mean, because what you have done in mean also, you multiply the probabilities with the cash flows and arrive at a overall number. This is called as mean. Risk. So students, just focus on this definition: deviation of possible outcome from the best possible outcome. What is best possible outcome? Mean. So deviation of any possible outcome from its mean is called as standard deviation. Okay. Or variance. So square of standard deviation is variance. Square root of variance is standard deviation. Okay, students, that we all know. I hope it is clear. Okay. So whenever we talk about average cash flow, best possible cash flow, it is always referred to as mean. So we have to apply all the calculation logics of how we calculate for mean. It is very easy, very simple. Nothing to worry. For risk, we call it, there is a deviation. Now that deviation is from mean. And from mean, what is the deviation we are talking about? The possible outcome. So that is denoted by standard deviation or variance. Now students, let us incorporate all these concepts into the techniques. Okay. So the first technique is actually discussed as probability. What is probability? Probability is a chance of an event occurring. Students, please let me know in case something is not clear or there is some query, or are you with me till now? Anumala is saying clear. Perfect. So that I can accordingly discuss those concepts which are not clear. Okay. So let's come to technique. In technique, the first one we are talking about is probability. Probability is a chance of an event occurring. So we all know that probability can range from 0 to 1, right? There can be a 50% chance, 40% chance, 10% chance, 90% chance, 100% chance, or 0% chance, right? So it will always range from 0 to 1. And whenever we talk about probability, it is forward-looking data. Correct? So we will always say that in future, there is a 10% chance that this will be the cash flow. And we have two formulas to understand here. One is expected net cash flow. Expected net present value. So students, just don't get confused with the expected word also, because this can be denoted by expected cash flow also. So we call mean as expected cash flow also. We can call it as average, expected, best possible cash flow, by whatever name called. Okay. So expected net cash flow will be what? Simply multiplying the cash flow, the net cash flow, with their probabilities, right? And taking a summation. 1 till n net cash flow for ith position multiplied by probability for ith. So first possibility, second possibility, up to n possibility, you take the cash flow and multiply with the probability and take a sum of. That is called as expected net cash flow. Second, expected net present value. So what is different here in this? The net present value. How you arrive at a present value? By dividing with the cost of capital, 1 plus cost of capital. So you take expected net cash flow divided by the expected net present value, with the divided by the cost of capital, you arrive at the expected net present value. So again, expected net cash flow divided by 1 plus k raised to the power t, and we have to take summation of t is equal to 1 up to n. So expected net cash flow, we have to divide it by the respective cost of capital for the different years. We will solve one or two questions, then we will be able to understand it better. Let's come to question number 3. So the application of these is very easy and very simple, which we can check it now. Okay, students? So the possible net cash flows of project A and project B at the end of the first year and their probabilities are given below. Okay. Discount rate is 10%, which is fine. For both the projects, initial investment is also 10%, 10,000, which is also fine. Calculate the expected net present value for each project. State which project is preferable. Okay. So it is very easy and very simple. We have been given different possible events, two different projects, cash flows and their probabilities, and the initial investment is also there, discount rate is also there. Can we calculate the expected net present value? Yes, very easy and very simple. So first of all, before calculating the expected net present value, we have to calculate the expected value, right? The expected value needs to be computed. So calculation of expected value. Possible event A, B, C, D, and E. Let's talk about project A first. So students, expected value is what? Mean. Mean is what? Probability into cash flow. $8,000, $10,000, $12,000, $14,000, and then it is $16,000. Let's write their probabilities. 10%, 20%, 40%, then another 20%, and then 10%. Can we calculate the expected value? Yes. Expected value. We just have to multiply 8,000 into 10%, so which is 800. 10,000 into 20%, 2,000. 12,000 into 400, 4,800. Then 2,800 and then 1,600. The total comes as 12,000. Then comes project B, cash flow, probability, and expected value. Okay, Kirti is saying, kindly explain formula of expected net cash flow. Kirti, this will be clear from these examples. Okay. It is very easy. Don't get confused with just, let's say, the summation sign that has been put. So it is just to say that you take every year's expected net cash flow and discount it using the discounting rate. Okay. So here the cash flow is 24,000. Just a second. Yes, 24,000, 20,000, then 16,000, then 12,000, then 8,000. Then probability is 10%, 15%, 50%, 15%, and then 10%. 2,400, 3,000, 8,000, 1,800, and 800. The total comes out as 16,000. So the So students, note, this is what summation here, right? We did a summation, and the summation is also done on the expected cash flows, right? These are the expected cash flows. Now we have to calculate the expected net present value. For project A, how we will calculate? 12,000 divided by 1 plus 10%. 10% is the cost of capital minus initial outlay was how much? 10,000. So 12,000 divided by 1.1 minus 10,000 comes as 909. Project B, 16,000. 1 plus 10%. So students, please note, in this question, there is only 1 year involved for cash inflow. Hence, we are only taking that 1 year cash flow and discounting it. Okay, students? 10,000. So 16,000 divided by 1.1 minus 10,000. This comes as 4545. In fact, this will be rounded off to 4544. Okay. So this is a single period question, and hence we just took the NPV accordingly. Students, are you there with me till now? I hope it is clear. Kirti, I hope formula is clear. So this formula again will get reinforced through our next example where we have multiple period issue also. Okay. This question had single period issue just to give you an overview. Mansha, given cash flow are estimated and by multiplying with probability, we get expected cash flow. Yes, correct. Very simple. We have to just multiply probability with the cash flow. We get expected cash flow, which is also called as mean, which is also called as best possible outcome. And then we have to arrive at the net present value using our regular technique. Okay, students. Now let us go to question number 4. Now this is a multiple period question. Okay. Year 1, year 2, and year 3. This will really help us to understand the expected net present value formula. Now the probabilities for next cash flows for 3 years of a project are as follows. Year 1, year 2, year 3. They have given the cash flows and the probabilities. Calculate the expected net present value. Expected net present value. Okay. Of the project using 10% discount rate if the initial investment is 10,000. Simple. Now, for calculating the expected net present value, we have to first calculate calculation of expected cash flows. Okay, that we have to do. So, year 1, year 2, and year 3. There are different possibilities. How they have mentioned possibilities? Okay, they have not mentioned anything. So, we can just simply start cash flow, probability, expected cash flow, probability, expected cash flow. Similarly, cash flow, probability, and expected cash flow. Okay, students. So the cash flows are 2,000, 4,000, 6,000, and 8,000. 1, 2, 3, 4. Right? 40%, I mean. So this is 200, 800, 6 3s are 1,800, 8 4s are 3,200. In total, this is 6,000. Cash flow, year 2, 2,000, 4,000, 6,000, and 8,000. Probabilities 20, 30, 40, 10. 20, 30, 40, 10. 2 2s are 400, 4 3s are 1,200, 6 4s are 2,400, 800. Total comes out as 4 12 24 8 4,800. Then year 3, cash flow is 2,000, 4,000, 6,000, and 8,000. Students, yes, 30% probability, 40% probability, 20% probability, and 10% probability. 2, 3, 600, 4, 4, 1600, 6, 2, 1200, 8, 1, 800. Okay. So the total comes as 4,200. So Manisha is asking if cash flow is 100% sure to happen, then it is a certain situation. So this I think you have already studied in your intermediate level, where for all reasons the cash flows are certain. But practically the cash flows are not certain, and hence there is a need to understand the element of risk and element of probability in this. Okay. Shailesh? Okay, perfect. So let's move ahead. So NPV using above cash flows will be 6,000 is for year 1 plus 4,800 is for year 2 raised to the power 2 plus 4,200 is for year 3 raised to the power 3 minus 10,000. I hope this formula is clear now. Expected net cash flow, expected net present value. Students, I think there was some question from Kirti, which I think now it is understood, right? So it is just simply dividing by the respective discount rates of the respective year and then arriving at the value, right? Simple. So the NPV comes as 2,573 in this example. Okay, students? Perfect. So question 4 was here till now. Yes. Now let's move ahead to our next topic. Yes. Now, students, let us elaborate this term. So we've understood about probabilities, we have understood about expected cash flow, and we have also understood about expected net present value. All three things we have understood. Now let us come to variance. Or standard deviation for that matter. What we said in case of standard deviation or variance, this is actually denoting risk, right? Risk of wrong estimation of the cash flows, risk that actual outcome will be different than the expected outcome. So we said that deviation of possible outcome from expected outcome. So this we said what is meant by expected outcome. This is actually mean, correct? So any deviation from mean for the possible outcome is called as variance or standard deviation. This is generally denoted by this sign. And as I said, square of this is called as variance. So while we talk about risk, you would have understood that in the in the previous part, I told plus minus 500, right? Where I said that cash flows average was 3,400 and risk was plus minus 500, where I said that it is a risk of coming down. The lower range is 2,900 and the upper range is 3,900, right? In that one example. So why this plus minus came? Because if you do a square root, correct, while opening, you will put both plus and minus. That is why in standard deviation, once you arrive from variance to standard deviation, you will put both plus minus, right? That is just a normal thing I'm explaining. Now let's come to the formula. The variance formula is defined as net cash flow minus expected net cash flow raised to the power 2 multiplied by probability I is equal to 1 to n. I will explain this formula in detail. So this is the formula for standard deviation. Sorry, this is the formula for variance. Okay, this is the formula for variance. Now, if you see students, what is this denoted? Net cash flow. This is a possible outcome. Okay. And this is what? This is actually mean. Expected net cash flow. The best possible outcome. Expected outcome. I hope this is understood. And if we want to calculate the standard deviation, so we just take a square root of this and we arrive at the standard deviation. Okay, Kirti is asking why there is in formula I is equal to 1. Okay, so Kirti, whenever we take this summation, okay, I'll explain. See, this I is equal to 1 means there are different possible outcomes. There is not a single possible outcome. There are, let's say, 10 of them. Now, we will take first. So this n will become 10, which is actually number of observations. So for each observation from 1 to 10, you have to perform this action, and then take a summation. You're getting my point? Then for first item, you will first take the possible outcome, reduce it from the mean, take a square, multiply with the probability. Then for the second observation, again, you will perform the same step. Third, same. Fourth, same. Like till up to 10th, you will take the same and then take the summation. That is why it is denoted like this. And n can be the number of observations in that series that we are talking about. Okay, Kirti. Now, can anyone tell me if higher variance is there or lower variance is there? So first of all, let's talk about higher variance. So will higher variance denote higher risk or lower risk? Students, can you please attempt this? If variance is higher, whether it will mean the risk is higher or risk is lower. Yes, students, please attempt this. Please help answer on this. Devansh is saying higher risk. Okay. Perfect. Devansh is saying higher risk. Is there anyone having a different view? Higher variance, does it mean higher risk or lower risk? So let's say there is variance of 10 and there is a variance of 20. So when there is a variance of 20, so 20 will mean higher variance? Higher risk. Yes, Shruti. Mansha, you're right. Higher risk. And Manoj, you're also right. Higher risk. Perfect. So higher risk means higher and lower means lower. Okay. So please remember, higher variance means higher risk and lower variance means lower risk. Manoj, you are also right. So Uday, okay. Lower variance, lower risk. Devansh, lower variance, lower risk. Shailesh, higher. Gurram, higher. Kirti, higher variance, higher risk. Suraj, higher risk. Perfect. All of you are right. Very good. Okay. Now, there's one question from Mancha. One doubt in ENCF, expected net cash flow. We already considered probability. Why there is in formula? We again multiplying it. No, wait. I'll come to this part. Okay, this is a good question. So Mancha is saying in this ECNF, we have already calculated the probability. Why are we multiplying it again? So Mancha, this is to calculate the average. First, you multiply the probability to arrive at mean. Now, once mean is arrived, that that has to be understood as a separate statistical term. Now you're arriving at the difference from that mean. Now the difference from that mean is this minus mean, but the probability of that is something that has to be multiplied. Okay. So this, Mancha, you will again get an understanding once we solve the next question. Tariq is saying higher the variance, higher the volatility. Perfect. Everyone is right. Now let me put one more question here. Project A. Project B. Okay. If I say that standard deviation, we can say standard deviation or variance in interchangeable way. And we know that what is the relationship between both of them. Okay, for risk, I can use standard deviation also and I can use variance also very much. So standard deviation here, it is plus minus 100 and here it is plus minus 120. Now everyone will say that project B is a risky project. Okay, Kirti is saying, what does I denote in formula? Kirti, I is just a representation of number of observations. So basically, summation I means that, so it is a standard notation in a summation formula. Okay, now I got your query. You are saying why we mention I. I is the ith term. I, we are representing a variable which will denote a ith term. I is equal to 1, I is equal to 2. Now for the first observation, I will be as 1. Then second, I will be 2, I will be 3, like that. Okay. So this is a standard notation, Kirti. Okay. So coming back. SD, standard deviation plus minus 100 plus minus 120. All of you will say that project B is risky. But what if I give you one more piece of information wherein I'll say that mean is 500 and 1200. Now this comes the question of the day. Now can you tell me which project will you accept and why? I've given you this information, standard deviation and mean for two different projects. Can you tell me which project will you prefer and why? SD is what? Risk. Mean is the expected outcome. Okay, students, please let me know whether you will prefer project A or project B. Yes, students. Shailesh is saying project B. Okay. Maybe if all of you can mention why you are suggesting project B also or project A also would also help me. So, okay, project B because high risk, high reward. Manoj is saying project B. Very good. Tariq is saying risk per unit of mean. That is where B is taken because of higher mean. Devansh is saying because of higher mean, but there is a higher risk also, right? So I think Tariq has actually got the exact point where I was referring to, and which is, so now, okay, there are other answers also, sorry. So Devansh is saying because of higher mean, okay, that we understood. Uday is saying project B. Perfect. Kirti, project B. Anumula Sai is saying project B has 10% risk and project A has 20% risk. Very, very good. Anumula Sai. Devansh is saying B. Anumula is saying, so we'll go for project B. Shruti is saying A, cause I calculated the variance. It's lower in A. Okay, Shruti. Perfect. So thanks for all of your thoughts. Now please hear me. See, you are given two different projects and you're given two different data points, standard deviation and mean. Okay, there are other answers also. Shailesh is saying first we will select higher returns, then consider risk. Okay. Shailesh is saying we will go with the returns first and then we will go to the risk. Manoj is saying project B is more viable. Uday is saying coefficient of correlation. Okay. This is not coefficient of correlation, but this is some other coefficient I will explain. On the basis of coefficient of variation. Yes, Devansh. Kirti higher risk, but in comparison to a higher reward. Perfect. So hear me out now, students. See, while you have to analyze this, don't you think that you have to come to a common unit between these two projects? What is that? What will be that common unit? For 1 unit of mean, how much risk we have to take? This is a very layman language I'm writing, okay? Now for 1 unit of mean, that means in division, we have to take mean. How many of unit of risk we have to take? 100 and 120. Can we divide and calculate? 100 divided by 500, it's 0.20. 120 divided by 1200, 0.10. So 0.20, 0.10. So for 1 unit of mean, which is the expected cash flow, I have to undertake a risk of 0.20 risk. And for 1 unit of mean here, I have to undertake a risk of 0.10 risk. So don't you feel for the same reward, I am getting a lower risk in project B. This is why we will select project B. And this that we have derived, this concept that we have derived from this discussion is called as coefficient of variation. I hope all of you will remember this for your lifetime now, right? Because it is a very logical calculation and discussion that we are doing, which says that coefficient of variation will be what? Coefficient of variation will be for 1 unit of mean, how much risk we have to undertake, so that we can compare to different projects. Okay. So logical answer says this. We'll go with B. Now let's come to the question. We have covered mean, we have covered standard deviation, we have covered coefficient of variation. Now let's try and do some questions on this. Calculate variance and standard deviation of project A and B on the basis of the following information. So this will help us in applying the formula of standard deviation. Okay. It's very easy and very simple. Okay, perfect. So there are no incremental questions. I was just checking that. Now let's come to the solution. Okay. So calculation of expected value for project A and project B. So students, first of all, for calculating the standard deviation or variance, we have to calculate the expected value, which is mean, correct? So this is our first step. So possible event A, B, C, D, and E. Project we will put, then cash flow probability, expected cash flow. Project B, I think, cash flow probability, expected cash flow. Okay. So this is 8,000, 10,000, 12,000, 14,000, and 16,000. Probability 10%, 20%, 40%, 20%, and 10%. So students, I'm just writing the total here, right? I'm not, I'm just trying to avoid the extra time because it's just a simple multiplication, okay? But you have to mention in exam the entire calculation. So don't skip that. Like 10, 15, 50, 15, and 10. So the total here comes out as 16,000. Okay, students. Now, this is the expected value. Okay. Now, calculation of variance. What are the possible events? A, B, C, D, and E. For project A, let's talk about first. Okay, what is the first possible event? The first possible event is 8,000. We'll go to our formula. 8,000 minus expected cash flow is 12,000 square multiplied by probability of A in project A, which is 10%. Okay, students? Similarly, the second B possible event for project A is 10,000. So we can just simply mention 10,000 minus 12,000 raised to the power 2. And what is the probability for B? 0.20. Similarly, 12,000 minus 12,000 raised to the power 2 multiplied by 0.40. Then for D possible event, what is the observation? 14,000 minus 12,002 into 0.20. Then last is 16,000 minus 12,000 raised to the power 2 multiplied by 10%. So the total here again comes as, so see, this is the summation that we are taking. So Kirti, just to answer your question, I here is equal to 1 to 5. 1 to 5. Okay. So while we are standing at A, I will be A. While we are standing at B, I will be B. C, I will be C. So that is why it was mentioned. Okay. This comes as 48 lakhs. Similarly for project B. Okay, let me mention here. Project B, A, B, C, D, and E. What are the different possible outcomes? These ones, right? 24, 20, 16, 12, 8. 24. What is the mean there? 16,000 raised to the power 2 multiplied by probability. Now, students, some of you might be wondering, why are we taking a square? Like raised to the power 2, why are we doing here? The reason is, if you don't do that, so your positive deviation will get offset by the negative deviation. Because in some of the observations, if you see, here is a negative deviation. Here is also a negative deviation. Because 8,000 minus 12,000 will give you minus 4,000. And here it is zero deviation. Here it is positive deviation. Here also it is positive deviation. If you do that, your positives will get offsets with the negatives and you will not get any deviation at all. But that is not the objective. The objective is we have to take deviation as deviation, whether it is negative and positive. And hence we have to take a addition of it. Okay, students? That is why we are doing a square, because the if you take minus 4,000 square will be 16. Like minus 4 will be 16, right? Yes, Mansha, is you're right. Variance is always positive. Standard deviation can be negative and positive both. Perfect. Yes, students, let's focus on. I'm just putting a total here again because of the timing, right? But okay, let me put the observations here. Then we can put. So then next is 20,000 minus 16,000 raised to the power 2. What is the probability? 15%. Then next observation is 16,000 minus 16,000 raised to the power 2. What is the probability? 50%. D part, 12,000 minus 16,000 raised to the power 2. What is the probability? 15%. Then 8,000 minus 16,000 raised to the power 2. What is the probability? 10%. So the total comes as 1 crore 76 lakhs. Now, standard deviation. So the variance is calculated. Question is also asking about standard deviation. So we will do for project A, standard deviation for project B. Here it will be 48 lakhs. Here it will be 1 crore 76 lakhs. 48 lakhs square root will be 2191, 2190.90, and 1 crore 76 lakhs will be 4195.23. Plus minus again, because once you open a square root, it is mandatory to have plus minus. No, Mansha is saying at point C we get zero deviation. It's called as median. No, this is not median. See, ideally median is something else, right? But C point, there is no deviation, is what we can call it. Okay. Or in a way, median is something which is in between the series. So Mansha, I mean, we can say, but let's avoid median discussion so that we don't get confused. Okay. Anumala is saying that means in worst case, cash flows will become zero as there won't be any negative cash flows. Practical case. Answers will here be negative, right? No. Wait. See, see, first of all, let me put these two things: cash flows and risk, right? So, risk is actually denoting changes in the cash flow. Finally, in your NPV calculation, you will take cash flow, right? You will not take risk. But risk is something that denotes changes in your cash flow. It can be plus, it can be minus. However, cash flow can be positive or negative both. You have losses, right? Let's say you are going to implement a machine in which first 3 years there will be losses because there is no demand. After fourth year, you expect demand to increase and then there will be positive cash flow. Till that there is negative cash flow. So positive or negative cash flow can be there. But what we are trying to say is risk is changes in the cash flow. I hope, Anumala, your answer is correct. In worst case, cash flows can also become negative. You're saying cash flow will become zero. I'm saying cash flow can also become negative. Okay. And negative cash flows are there, definitely there. What about loss making projects? Those have negative cash flows, right? So in that case, your NPV will never become positive. Okay, so let's think it from the practical perspective. Uh, Question number 6. Okay, before this, now we have to, yes. So I think till question number 5, are all of you clear? Now let's say if this question itself asks you to calculate coefficient of variation, right? SD divided by mean. Simple. For both the projects, can you do that? Yes, both the values are there. So this will be 2190. 190 divided by, what is the mean for first? 12,000. This is for A project. Similarly for B project, 4195. This is for B project. Okay. Simple. I hope this is clear. Okay, students. Now let us go to the next concept. Yes. Risk adjusted discount rate, which is also called as RADR. So students, just to sum up, let's sum up before we start this. We discussed the current trends in capital budgeting in the opening session, where we discussed about inflation, nominal rate, real rate. Then we discussed about changes in technology. Then we also discussed about changes in the government policy. Then in the second part of the session, we started our discussion from the risk part in the capital budgeting, where we discussed about three situations: certainty, uncertainty, and risk. And we took risk ahead and discussed standard deviation and variance is called as risk. Then we discussed about probabilities, how probabilities play a role in calculating the expected cash flow, in calculating the expected net present value, and hence how risk and mean together can be analyzed using the coefficient of variation. Okay. This, just to sum up, this is what we discussed. Now let us come to another different topic called as risk adjusted discount rate. So students, in our opening session, in the first half of the session, we discussed that interest primarily is paid because of two things: time value of money and risk, right? Risk of non-payment of principal and interest both. Correct. And what is that risk? The risk can be anything. So risk is the deviation of possible outcome from expected outcome. My expected outcome was that I will receive all the money, but possible outcome is that there are chances that 10% of the money will not be paid to me because the person who has taken borrowing from me is not capable enough. So time value of money we already discussed under the inflation part, right? Now we are elaborating on risk. Clear, students? Till now with me? Okay. Yes. So the use of interest in capital budgeting is a discount rate, right? Why we use interest rate? To use it as a discounting rate. We discount our present value. We discount our cash flows to the present value using this. Similarly, we discount our, let's say any other, let's say cash outflows or incremental things that are going to happen using the interest rate. Now, if you see, discount rate has two things. risk-free rate plus risk premium. This concept we are borrowing from capital asset pricing model, CAPM, which all of you are already aware. So there is a risk-free rate and there is a risk premium. Both of them constitute the discount rate. Why there is a risk premium? Because the underlying security, the underlying project, the underlying business has risk associated with it. Correct. And while you are investing in that, you are undertaking that risk. Because you are undertaking that risk, there has to be some consideration for that risk being undertaken. So scenario one, risk-free rate is 7%, risk premium is 8%. You're having a discount rate of 15%. Scenario 2, risk-free rate will remain same because risk-free rate generally comes from the government bonds, which are the most secured form of lending or borrowing, plus 4%, 11%. Now, if you use 15% or 11% as your discounting rate, definitely the lower NPV will be derived by using which rate, whether it is 15 or 11. Can all of you apply your minds and answer? If I use in the same project 11% rate of interest, will I get a higher NPV or lower NPV when compared to 15%? Yes, students, please answer. So the higher or lower NPV will be given by what? So the lower NPV will be with 11% or 15%. Tariq is saying 15%. Very good, Tariq. Yes, students, please answer. Where will you get lower NPV? So lower NPV is an outcome of higher discount rate, correct? Because your cash inflows are going to come in future. If you are using higher discount rate, the present value will become lower. And the present value of the cash inflows, it will become lower. It will result into the lower NPV. Yes, I think all of you are right. Mansha, lower NPV at 15%. Devansh, 15%. Anumila, 15%. Suraj, 15. Perfect. Everyone is correct. So the point which I'm trying to make here is that lower NPV, higher risk. Higher NPV, lower risk. Is this thumb rule clear? If the project is risky, your risk premium will be higher and it will be, let's say, 15%, and it will result into a lower NPV. If your project is less risky, the risk premium will be lesser and your overall discount rate will be 11% and you will get a higher NPV. Okay, students, I hope you understood the correlation now. So the higher risk will mean higher risk premium. Higher risk premium will mean higher discounting rate. Higher discounting rate will mean lower NPV. Okay. So Manisha is saying that this cost of capital is at nominal rate. You can take it as nominal rate only as of now. This discussion is at nominal rate. Okay. Then fourth approach is certainty equivalent approach. This is called as CE coefficient. So we will understand both RADR and CE approach. Then we will do the questions. So under RADR, which is risk adjusted discount rate, it simply means higher project will be adjusted by higher risk. And sorry, the higher risky projects will be adjusted by the higher risk premium and they will result into lower NPV. Okay. Now what the certainty equivalent approach says? In this also, I am taking two situations. just to compare and then build the concept. Situation one says that for the particular project, okay, there is a risky cash flow of rupees 2 lakhs. For the same project, situation two that I'm giving to you, it says that guaranteed cash flow will be 1,50,000. This is actually what certainty is, right? That we discussed above. Certain, uncertain, and risk. So risk is, if let's say you undertake a risk, you will get a cash flow of 2 lakh. If you want to be a guaranteed 100% sure shot amount, it will be 1,50,000. So for the same project, for the same year, for the same cash flow, these are the two different data points that are given to you. Now, coefficient of certainty equivalent, what it is stating? It is stating that out of the total risky cash flow, what percentage is actually a certain cash flow? So 75% of a risky cash flow is a certain cash flow. Students, are you with me till now? So the coefficient of CE equivalent says that 0.75 times of risky cash flow will be guaranteed cash flow. I hope this is clear, students. Now, what is the relevance? We will connect this with RADR, do the comparison, and then we will come to the questions. So 2 lakh was our risky cash flow, correct? This will be splitted into two, 1,50,000 and 50,000. This will be our risk premium, right? So 2 lakh risky cash flow, 1,50,000 is the guaranteed amount, and 50,000 is the risk premium that has been charged. So just to conclude, certainty equivalent, how it is calculated? Guaranteed cash flow divided by the risky cash flow. And if you want to calculate the guaranteed cash flow, can you take the risky cash flow and multiply in this certainty equivalent? Yes. So we have discussed about two different standalone concepts. One is RADR, which deals about the discount rate. It says that higher risk in a project will have to be evaluated by the higher risk premium discount rate to lead a lower NPV. The certainty equivalent approach says that you have to come to a coefficient of certainty equivalent, and if you are doing the certain cash flows, so the risky cash flows has to be adjusted to the certain cash flows to do the NPV calculation later on. Yes, Suraj. Generally, here we are talking about cash inflows because practically most of the cash outflow happens on day one itself. Let's say before the project starts, the most of the capitalization happens there. Okay, students. So mostly we're talking about the cash inflow from a futuristic perspective. Yes. Now let us link these concepts and implement them in our solutions. Okay. Now, so students, RADR, risk adjusted discount rate, certainty equivalent approach. If there is a risky project means that the risk element is high. Increase the discount rate. If we follow RADR method, under RADR method for a risky project, it will increase the discount rate. Impact is reduce NPV. In case of certainty equivalent method, it will reduce the cash flow, right? It will reduce the cash flow because your CE, certainty equivalent coefficient, will become lower, and it will also reduce NPV. By cash flow here, I mean cash inflow. Okay, students. But RADR has a limitation. It assumes same risk premium for all the years. Okay. But CE can have different certainty equivalent for different years. Okay, so there is a limitation there, which I have just now told all of you that CE, you can assume different certainty equivalent for different years, RADR, same risk premium, and hence realistically RADR is not used, but CE is used. Now, if you are solving a question using RADR, then you have to keep in mind two things. If you're talking about cash flows, so the risky cash flow you have to take, and discount rate also you have to take risky, the one that includes risk. Including risk, including risk premium. And if you're using certainty equivalent method, cash flows will be excluding risk. That means the guaranteed amount, and discount will also be risk free. Discount rate. Clear, students? Like the same thing that we discussed, Apple versus Apple. Nominal interest rate, nominal cash flow. Real interest rate, real cash flow. Similarly, RADR. If the cash flows include risk, in the discounting rate also you include risk. Certainty equivalent. If the cash flows excludes risk, in the discount rate also you exclude risk. Now let us come to question number 6 and do a lot of practice on RADR and CE approach. Yes. Okay. An enterprise is investing rupees 100 lakhs in a project. The risk-free rate of the return is 7%. The risk premium expected by the management is 7%. So they have given the risk premium and the risk-free rate both. The life of the project is 5 years. Following are the cash flows that are estimated over the life of the project. These are the different cash flows that are given. Calculate NPV. NPV of the project based on the risk-free rate and also on the basis of the risk-adjusted discount rate. Okay. So these are the two parts that they've given to us. So the questionnaire here is explicitly said that you first calculated basis the risk-free rate and then you adjust the rate to include the risk. Okay. So year 1, 2, 3, 4, and 5. Cash flows 25, 60, 75, 80, and 65. Discounting at the rate 7%, right? So risk-free rate is 7%, right? So first we will solve the question using 7%. So the factors are 0.935, 0.873, 0.816, 0.763, 0.713. So the present value of cash inflows will be how much? Multiply, we do 23.38, 52.38, 61.20, 61.04, 46.35. The total is 244.34, and we will reduce the cash outflow initial value, which was 100 lakhs, which is 1 crore, okay, which is 144.34. Okay, students. So this was a plain vanilla NPV calculation question where the amount has been calculated using the discount rate at 7%, which was the requirement of the question. Now, the second requirement of question is to solve this using risk-adjusted discount rate. So what is risk-adjusted discount rate here? Risk-free rate plus risk premium that we discussed. Okay, students. And in this question, 7% is risk-free rate and 7% I think is the risk premium. Let us check once. Yes. So the discounting rate in this case becomes 14%. So the net present value at the rate, 14% will be, again, we will put years 1, 2, 3, 4, and 5. The cash flows 25, 60, 75, 80, and 65. Now, discounting factor at the rate 14%, it will be 0.877, 0.769, 0.675, 0.592, 0.519, and then we will multiply to get the present value. 21.93, 46.14, 50.63, 47.36, and lastly 33.74. So the total amount becomes 199.79 less cash outflow of 100 lakhs. This becomes 99.79 NPV. So Tarek is also saying that RADR can be 7% plus 7%. So So if you refer Tarek, the capital asset pricing model also CAPM, there we add the risk premium to the risk-free rate to arrive at the overall interest rate. Correct. So the same concept we have done. So hence I would say that for RADR purposes, please avoid multiplying the rates. Let's say 1.07 into 1.07. That might not be the right approach. Okay. Manisha, again check. Yes. So Manisha, 144.34 is basis the risk-free rate. Now, here there is an interesting comparison. If you see risk-free rate and RADR rate, 7%, 14%. What is the NPV in both the cases? Here it is 99.79 and here it was 144.34. So students, please note, as we were discussing earlier, that since you increase the risk premium in your discounting rate, it will lead to lower NPV. So see, the NPV has gone down. So if you really want to build the riskiness in your project, you can do it in two ways. While reducing your cash inflows to adjust for the higher risk, or you can increase your discounting rate by including the higher risk premium. Okay. Kirti is saying higher rate, lower NPV. Yes. Okay. Tarek is now saying in CAPM we multiply beta. So Tarek, I'm just taking that as an analogy. Now, why we multiply beta there is because we are talking about a specific factor and the risk premium that we take is the market rate minus that risk-free rate. Right. Here already we are talking about the risk premium of that specific project. Right. Hence, there is no use of beta. Okay. I hope this is clear. Now, students, we also have some interesting MCQ questions. So, towards the end of this, I would expect, all of you to answer and attempt the questions that are flashed on the screen. Please revert with the correct answer. So, the first question is, expected cash flows are calculated as. So, there are four options. Sum of likely cash flow of the project, sum of likely cash flow of a project multiplied by the probabilities of the respective cash flows, sum of likely cash flow of a project divided by the probability of the cash flow, and none of the above. So all students, please give your respective answers on the screen. It would help us and it would help you also to sum up what you learned today. Yes, so Mansha has mentioned her answer. I'm not revealing that as of now, but I expect all of you who have participated today to please respond with the correct answer as per you. So expected cash flows we studied are mean, correct? So what will be mean? Tarek, Kirti, Uday, yes. So I think all of you are correct. It is B. B is the correct answer, where it says that sum of likely cash flow. Now here the word likely is used. We can use possible also, right? As we discussed, sum of likely cash flow of project multiplied by the project probability of the respective cash flows. So we have to multiply and then arrive at. Gururam, B, yes. Anumula, B. Devansh, yes, B. Perfect. All of you are correct. Now the second one. Yes. This involves a little bit of calculation. So just go through and attempt this as well. The firm expects an NPV of rupees 10,000 if the economy is exceptionally strong, 30% probability. NPV of 4% for 4,000 if the economy is normal, which is 40% probability. And NPV of 2,000 if the economy is exceptionally weak, which is 30% probability. So the expected net present value is, so NPV and probability. I'm just writing it for ease of your reference. Please do attempt this question as well, students. Now, please post the answer for the second MCQ. So first one it is 10,000, 30%, 4,000, 40%, and last one is 2,000, 30%. So yes, students, please answer this. What will be the expected net present value in this case? So Anumala has replied first. Can we expect others also to answer? Oh, there are mixed answers. Devansh, I think your two responses have come. Please check again. Suraj, okay. Guram, okay. Yeah, Devansh, you have mentioned. Okay, perfect. I think all of you are correct. It's A, which is 5,200. Yes. So variance measures. What is the correct answer? We just now discussed how far each number is the set is far from the mean. Is from the mean of a given data set, a return on investment, level of risk borne by every percent of expected return. Yes, students, come on. So Mansha has replied, Kirti has replied, Manoj. Okay. Manoj Kumar Pandey, please recheck. Mansha, you're right. Kirti, you're right. So variance measures what exactly? Anumala, you're right. Correct. Devansh, you're right. So I'll reveal the answer now. Variance measures how far each number in the set is from the mean, which is deviation from the mean, correct? That's what we have been discussing in our session. Deviation of possible outcome from expected outcome. Okay. Okay, no, wait. Suraj, Uday, Guram, all of you are saying D. What is this D? Okay, now tell me, you all know this. What is this D? We have also discussed this. What is this D called? We have discussed it today, students. So Suraj, Uday, and Gurram, D is not the correct answer, but I am asking what is D refers to. D is not variance. No, Mansha, D is not standard deviation. Level of risk borne for every percent of expected return. We discussed it through comparison, project A and project B. Level of risk borne for every percent of expected return. Please formulate it. Risk divided by return. What does this stand for? Yes, Devansh, Tarek, Suraj, all of you are right. This is coefficient of variation. Perfect. Okay. So, I think with this brings to an end to the today's session. I would request C. Ashish sir, who is there with us, to help with the closing remarks and his expert comments. Yeah. You, sir.
Thank you. Thank you, Devas. Am I audible?
Yes, sir, you're audible.
Your session was very interactive because throughout your session I was there. However, in some time I could not attend the same, and especially the session was so actually there was some discussion regarding beta etc.
Yes.
So what is the issue this with this paper is that beta is basically discussed in the topic of portfolio management, but however it is also covered here. So here the situation is like that: which came first, a hen or an egg?
Okay.
And it is a problem with this paper. Anyway, anyhow, we have to manage the same. It is not an issue. And
Yes.
there was one question regarding negative interest rate. I think have you replied the same, Devas? I could not catch you on this
Yes,
one.
sir. Yes, sir. That is not replied yet, sir. Please, we can hear
Can
from.
I can I
Yeah.
can I
Yes,
reply
sir.
it?
Yes, sir. Yes, sir.
Okay.
Yes.
Okay. Okay, student, your question was very interesting. However, it is seems very unreal that their interest rate can be negative, but of course it happens because in some countries, even today in Japan, the interest rate is negative, that is minus 0.10. This rate was in December 2023. Earlier, around 2020, even in Switzerland and Sweden, and in some countries of Eurozone, the interest were negative. Now, question arises: why the interest is negative? Student, please note that the interest is sometimes negative to because government wants to achieve some inflation target. Because they say कि if the rate of loan is will be lower, then student then public will or the general public will consume more and more goods. Once the goods will be consumption will be there, then of course the demand will rise, then prices will also rise and inflation. Because sometime monetary policies for to meet some targets and even some government to meet some objective of monetary policy, some inflation has to be achieved to sustain the economic growth. So this can be the reason. And another reason is that when we will discuss the foreign exchange topic, then certainly we will come to know when their interest rates are lower. So our currency, our export become stronger and our import become costlier. So it also helps in that way. Anyhow, there is a concept of nominal and real interest has been discussed in great detail, and I think it will also help you to understand the interest rate parity theorem when it will be covered in foreign exchange risk management topic. So, with this, I think the discussion was overall very fruitful for the you. And in case if you have any query, so there was just
Yes,
not
sir.
on the slide, write down the number.
Yes, sir.
It is 0120 dash, this is STD code 3045 956. Okay, student. So you can also send your queries on a mobile app also. So we shall continue this topic in the next class. Okay. Then we shall take up other sub part of this topic, and Divas sir shall take the session. And since your response was very good, so I hope the students will also attend the same session with the same encouragement and enthusiasm. Thanks a lot, Devas, for sparing your precious time and taking this lecture. And
Thank you,
thanks,
sir.
students, for listening to the lecture online. You
Thank you,
have a
sir.
nice day. Okay.
Thank you, sir. Thank you. Thank you.
Ashok ji, session is over.
Session is over. हाँ जी.